I mean, you started your career at a time when risk was a much different thing, at least relative to what we saw over the last 15 years or so here. So what does that mean for the next generation of investors? What are they facing when it comes to how they have to assess that risk?
Well, anybody who joined after '09 pretty much only saw good times, except for a couple of bad months in 2020 in connection with the pandemic shutdown. But, you know, for my first 30 years in high-yield bonds, 78 to '08, the average default rate was about 4% a year. In the last decade, it was only 2% a year. I think 4 is more normal. And, you know, defaults and bankruptcies should not be that scarce. And I think we'll be going back to a somewhat harsher environment.
Well, let's unpack that. I mean, start off first with the rally that we've been seeing lately in high-yield debt. What do you make of that? Do you see it as sustainable, persistent?
Well, I think the current prices are roughly sustainable. When you say, is the rally sustainable, they're not going to keep going up. That is to say, yields are not going to keep coming down, in my opinion. You know, I think that rates are roughly where they can stay, except that I think it's important to recognize that the debate today is being dominated by people who are optimistic, by people who think that the recession won't be too bad, won't be too long, that the inflation will give way, and that the Fed will be able to turn accommodative soonish.
Are you optimistic?
Not on that subject. I mean, you know, I think that the Fed is going to want to be somewhat strict and hold that position, well, let's say, throughout the year. I don't think the Fed wants to be seen as being optimistic, you know, hawkish, dovish. They want to have some constancy.